prior to the reorganization of 1930. In the former setup, the first fives were followed by a large fixed-interest bond issue, the requirements of which, including their maturity, precipitated a receivership in 1933, following which the first fives sold as low as 30. Significance of unusually large stock value ratio. As we have previously intimated, if the stock value ratio were always proportionate to the interest coverage, in the manner suggested in the foregoing table, there would be no reason to apply both tests, since the passing of one would assure passing of the other. Such is not the case, however, and we must accordingly consider what is implied when the stock value ratio gives a substantially different indication from that given by the interest coverage. Let us assume first that the earnings picture is not completely convincing, but that the stock value ratio is considerably higher than our minimum requirement. Example. Referring to the Fairbanks-Morse example on page 130, the investor would be impressed by the fact that at the lowest market price in 1938, the stock-equity ratio was more than 2-to-1, about $12 million market value of stock behind $5,600,000 of bonds. This evidence of strength might well dispel any doubt arising from the inadequacy of the straight 10-year average. Significance of a subnormal stock value ratio. The opposite case is that in which the interest coverage may be called satisfactory, but the stock value ratio is substantially below the minimum required. Examples. The problem here may be better understood by the use of two contrasting examples, one taken in the midst of depression and the other at the peak of recovery. The first is that of Inland Steel 4.5s, due 1978, which sold in September 1932 at 82 to yield 5.6%. The relevant data may be found in the accompanying PDF, together with corresponding figures for Crucible Steel 5s due 1940, which are supplied for comparison. It will be seen that the Inland Steel issue met our earnings test based on a 6.5-year average, but failed to meet our stock ratio test. Most investors would reason that the bond was a very sound and attractive investment at the time because, 1, Inland Steel was one of the best steel companies with a fine pre-depression record, and 2, the 1932 figures, both for earnings and for stock prices, were so abnormal as to afford no guide to the safety of the bond issue. The fact that the company's earnings recovered later on and that the bonds were called at a premium in 1936 would be pointed to as confirming the soundness of this view. But the weakness of the reasoning lies in the fact that it required certain assumptions as to the future which should not be needed to justify the purchase of an investment bond. Note that under the conditions of 1932, the price of 82 for Inland Steel 4.5s put them distinctly in the investment class. This should be clear if we compare the exhibits of the Inland and Crucible issues. It will be seen that both the earnings coverage and the stock value ratio were better for the Crucible issue, yet the yield on the latter was twice as high as for the Inland bond. The purchaser of the Inland Steel 4.5s would have to assume not only that the 1932 conditions were transitory, a necessary assumption if there was to be any buying of securities, but also, 1, that the price of Inland Steel stock was much too low, and 2, that the price of Crucible Steel stock issues was much too high. For unless the Inland stock was selling too low, the Inland bonds could not be considered safe. And unless the Crucible shares were selling too high, he would have been much better advised to buy the lower-priced Crucible bonds. This would seem to be entirely too complicated and doubtful a basis for a straight bond investment. It is true also as a general rule that no bond investment should be made if it requires the assumption that the common stock is selling too low at the time. If the investor is right in that judgment of the stock value, it would certainly be more profitable to buy the stock than the bonds. If he is wrong as to the stock value, he runs great risk of having made a poor bond purchase. The fact that the Inland Steel bonds were later repaid at an advance of some 20 points does not invalidate our logic, but rather confirms it. For by the same time, Inland Common had advanced over fourfold in value, and the Crucible Steel 5s had risen from 60 to 102. We advert once more to our controlling principle that bond investment is a negative art. This discussion was not intended to imply that the Inland Steel 4.5s were a poor investment. The contrary is clearly the case, but we wished to point out that a logical examination of the picture at the time would not have led to an affirmative verdict for that issue, particularly in view of the alternative investments offered. A second example. We may buttress our argument further by introducing an opposite type of illustration. The Brooklyn Manhattan Transit 4.5s, due 1966, which sold at 104 to yield 4.27% in January 1937. The average earnings coverage here was about adequate, judged by our minimum standard for railroad bonds. However, the stock-value ratio, even at the high general market level then obtaining, showed less than 40 cents of stock for each dollar of bonds. This meant, in essence, that the stock market was not sufficiently optimistic as to the prospects of the BMT to value the equity issues at our minimum requirement in relation to total debt. The bond buyer would have been well advised to take this deficiency in the secondary test as a hint to look elsewhere for his 4.5% investments. By December of that same year, the bonds had fallen to 44. Our reference to the stock market's valuation of future prospects of Brooklyn Manhattan Transit suggests that the stock equity test is not merely an additional quantitative criterion of bond safety, but that it is in good part a qualitative index as well. A third function of the stock value test may be to throw justifiable doubt on the complete accuracy of the reported earnings figures. In the case of BMT, a careful study of the offering prospectus would have revealed a wide difference between depreciation and amortization charges as shown on the reports to security holders and as taken on the income tax returns. The more conservative depreciation basis would have reduced the interest coverage to well below our suggested minimum. Stock value ratio for railroad and public utility companies. In the case of industrial companies, the stock value ratio may be easily calculated. Railroads and public utilities, however, are likely to present various complications. In addition to the bonded debt as shown in the balance sheet, it may also be necessary to consider rental obligations equivalent to debt and preferred stocks of subsidiaries ranking ahead of parent company bonds. These difficulties militate somewhat against the use of the stock value ratio test for railroad and utility bonds. However, we believe that a careful investor should apply the stock value test in these fields as well as to industrials. As we shall point out in the next chapter, the stock value test would have been of great utility in guarding against the mistaken purchase of many railroad bonds at high prices during 1935 to 1937. In the next chapter also, we shall describe the procedure of capitalizing the fixed charges to arrive at a fair estimate of total debt when the balance sheet may not tell the whole story. Stock value test not to be modified to reflect changing market conditions. The question arises, to what extent should the stock value ratio test be modified to reflect changing market conditions? It would seem proper to expect, and therefore to demand, a higher relative market value for the stock behind a bond issue when times are good than during a depression. If $1 of stock to $1 of bonds is taken as the normal requirement for an industrial company, would it not be sound to demand, say, a $2 to $1 ratio when stock prices are inflated, and conversely to be satisfied with a 50 cent to $1 ratio when quotations are far below intrinsic values? But this suggestion is impracticable for two reasons. The first being that it implies that the bond buyer can recognize an unduly high or low level of stock prices, which is far too complimentary an assumption. The second is that it would require bond investors to act with a special caution when things are booming and with greater confidence when times are hard. This is a counsel of perfection which it is not in human nature to follow. Bond buyers are people, and they cannot be expected to escape entirely either the enthusiasm of bull markets or the apprehensions of a severe depression. We should not propose a rule, therefore, by which investors are to require a larger than usual stock-value ratio when prices are high, for such advice will not be followed. But if the bond buyer is personally convinced that stock prices are dangerously high, he would be wise to insist on a stock-equity coverage well above our minimum ratios. Nor shall we propose the opposite rule for bear markets, particularly because by diligent search, it will always be possible to find some investments that meet all the normal tests even under depressed conditions. Chapter 12. Special Factors in the Analysis of Railroad and Public Utility Bonds. Railroad Bond Analysis. The selection of railroad bonds can be made a process of extreme complexity. The reports of the carriers to the Interstate Commerce Commission contain voluminous data on the financial and physical condition of the railroads, which supply material for elaborate analysis. A really thorough study of a railway report would devote attention to the following items, among others. 1. Financial. A. Composition and trend of operating revenue. B. Ratio of maintenance expenditures to gross. C. Relative amount and trend of transportation expenses. D. Character of other income. E. Coverage for and relative growth of interest and other deductions. 2. Physical. A. Location. B. Amount of double and third track. C. Weight of rail. D. Character of ballast. E. Amount and capacity of equipment owned. 3. Operating. A. Character and density of traffic. B. Average haul and average rate received. C. Train load. D. Fuel costs. E. Train and car mile operating costs. F. Maintenance charges per unit of equipment. In addition to the above items affecting the railroad as a whole, a special study can be made of the mileage covered by the mortgage lien under consideration. Elaborate technique of analysis not necessary for selection of high-grade bonds. Comprehensive analyses of this kind are actually made by the investment departments of large financial institutions which purchase railroad bonds. They are, however, not only clearly beyond the competence of the individual investor, but in our opinion, they are hardly consistent with the true nature of high-grade bond investment. The selection of a fixed-value security for limited income return should be, relatively at least, a simple operation. The investor must make certain by quantitative tests that the income has been amply above the interest charges and that the current value of the business is well in excess of its debts. In addition, he must be satisfied in his own judgment that the character of the enterprise is such as to promise continued success in the future, or more accurately speaking, to make failure a highly unlikely occurrence. These tests and this expression of judgment should not require a highly elaborate technique of analysis. If the investor in railroad bonds must weigh such factors as a favorable train load trend as against a poor diversification of traffic handled, he is called upon to exercise penetration and skill out of all proportion to the reward offered, viz., a fixed income return of from 2 3/4 to 4.5%. He would certainly be better advised to buy United States government securities, which yield a lower return but are safe beyond question, or else to let one of the large savings banks invest his money for him with the aid of its extensive statistical staff. Recommended procedure. The complexities associated with railroad bond analysis have arisen naturally, but in our view rather illogically, from the wealth of data available for study. The fact that a mass of figures is obtainable does not mean that it is necessary or even advantageous to dissect them. We recommend that the buyer of high-grade railroad bonds confine his quantitative study to the coverage of fixed charges. with due attention to the trend of earnings and the adequacy of maintenance expenditures and to the amount of the stock equity. If he desires to be particularly careful, he will probably be better advised to increase his minimum requirements on these 2 points rather than to extend his statistical tests to numerous other features of the annual reports. It may make our viewpoint clearer if we add that such elaborate analyses may at times be of real value to the purchaser of speculative railroad bonds or stocks as aids to his judgment of what the future will bring. But the whole raison d'etre of fixed value investment is opposed to any primary reliance upon surmises as to the future, since the field for exercising such judgment must logically be among those issues which offer possibilities of gain as a reward for being right, commensurate with the penalties attached to being wrong. Technical aspects of railroad income analysis. The application of the interest coverage test to railroad bonds involves a few technical questions which require attention. Railways have various kinds of fixed charges which are obligations equivalent to bond interest and which clearly should be included with such interest in calculating the margin of safety. There are also certain deductions which partake to some extent of the nature of fixed charges and to some extent also of operating expenses. Furthermore, there are credits designated as other income, such as bond interest received, which may properly be considered as offsets to interest paid, at least for the purpose of comparison with other roads. In the following schedule, we allocate the more important items of this character that are encountered in railroad statements. 1. Bond interest and equivalent charges. A. Interest on funded and unfunded debt. B. Rent for leased lines. C. Joint facility rents, net debit. 2. Deductions midway between fixed charges and operating expense. A. Hire of equipment, net debit. B. Miscellaneous rents and miscellaneous deductions. 3. Credits that may be partially offset against bond interest in order of dependability. A. Bond interest received, rent for leased lines, joint facility rents, net credit. B. Hire of equipment, net credit, dividends received. C. Miscellaneous non-operating income. Methods of computing fixed charge coverage. Considerable argument might be indulged in as to the most scientific way of handling all these items in order to arrive at the best formulation of the fixed charges. The matter may be simplified, however, by bearing in mind that the bond buyer is not interested in exactitude, but rather in reasonable accuracy. After all, the data he is dealing with represent past history, the sole value of which is to serve as a hint or clue to the future. For such a purpose, refinement of calculation is of little benefit. We suggest that for railroad bonds, the necessities of the case with respect to interest coverage may be met by setting up a double test and requiring that the minimum margin be shown by each. The method proposed is as follows. Test A. Number of times fixed charges are earned. Fixed charges equal gross income minus net income, times fixed charges earned equals gross income divided by gross income minus net income. Note, gross income is the net after rents plus other income. Net income is the balance available for dividends. Test B, number of times net deductions are earned. Net deductions equals railway operating income minus net income, times net deductions earned equals railway operating income divided by railway operating income minus net income. Note, railway operating income is the same as a net after taxes, that is, the gross revenues minus operating expenses and taxes. It is necessary to apply only one of these two tests, viz., the more stringent one, which may readily be identified by inspection. The rule is as follows. If gross income exceeds net after taxes, apply the fixed charges test. Test A. If net after taxes exceeds gross income, apply the net deductions test, Test B. The application of these alternative tests will be clear from the examples as shown on page 161, which may be found in the accompanying PDF. Notes on the foregoing tests. 1. Chesapeake and Ohio represents the typical exhibit in which the results of both tests would have pointed to the same conclusion, in this case to the presence of a satisfactory margin of safety for the bonds. 2. In the case of Chicago Great Western, Test A, which is ordinarily applied, would not adequately reflect the burden of the unusually large rental deductions. Their effect is shown by Test B, and, in accordance with our suggestion, this less favorable result should be the one considered by the investor. 3. Northern Pacific presents the opposite situation. Its other income has been exceptionally large as compared with the bond interest, so that in most years the net deductions figure out as a credit. In this case, the investor should follow the results of Test A and consider Test B as a secondary indication of strength. The Pennsylvania Railroad's reports offer an exceptional case in that the larger part of its substantial other income is a direct offset against the fixed charges. These other income items consist of interest and guaranteed dividends received on securities of the system itself, which are owned by the parent company, so that the same items appear later as interest and rentals paid. In 1938, these offsetting amounts totaled some $30,298,074. They should properly be eliminated from the statement altogether. The effect of their inclusion was to reduce the indicated coverage under the fixed charges test, as can be found in the accompanying PDF. In this case, the net deductions test afforded a fairer criterion than the fixed charges test uncorrected. Where an especially careful analysis is to be made, the reported figures should be adjusted as above indicated on the basis of the available facts. Bearing of maintenance expenditures upon fixed charge coverage. There are two important items in railroad accounting which are subject in some degree to arbitrary determination by the management, and which may therefore be treated in any one year in such a manner as to produce deceptively favorable or unfavorable results. The first of these is the maintenance account. If unduly small amounts are spent on upkeep of road and equipment, the net profits are thereby increased at the expense of the property, and the balance reported as available for fixed charges does not fairly represent the earning power during the period under review. Bond buyers might do well to examine the maintenance ratio, that is, the percentage of gross revenues expended on upkeep of way and rolling stock, in order to make sure that it is not suspiciously below standard. Unfortunately, it is difficult to determine with any degree of assurance just what should be considered a standard maintenance rate for different groups of carriers. Prior to 1931, a figure of about 33% of gross operating revenues was so generally and consistently reported that it undoubtedly could be considered a norm, any wide deviation from which deserved special study. Since 1930, however, there has been a moderate decline in this percentage figure concurrently with a major shrinkage in the gross operating revenues against which it is computed. As a result, actual dollar expenditures for maintenance have been cut nearly in half. Somewhat surprisingly, the maintenance of way outlays in dollars, which presumably are not so subject to curtailment on account of smaller traffic, suffered a decline of 51% in 1933 to 1937 as against 1926 to 1930, whereas maintenance of equipment costs were reduced by 39%. On the other side must be set the undoubted improvement in the technology of maintenance as shown in the use of more efficient methods and more durable materials. The cost of maintaining railroad property in adequate condition is now substantially less than it was prior to 1931, but how much less we cannot say with assurance. Hence the difficulty of determining whether the average ratio of about 30.5% on the reduced gross of 1933 to 1937, shown by all Class I railroads, is sufficient to reassure the bond buyer against the existence of under-maintenance. Our judgment leans to the view that this figure is rather low and that a somewhat higher ratio, say 32%, might better be taken as the investor's norm. If this suggestion is accepted, it would mean that when considering bonds of a railroad spending less than 32% of its gross on maintenance, the investor will either, 1, make such further study as will convince him that the lower rate is adequate, or 2, adjust the reported earnings to a hypothetical 32% ratio, thus reducing the earnings coverage correspondingly. If the coverage is satisfactory after this correction, it may be assumed that the possible under-maintenance is not in itself a serious enough factor to impair the safety of the bond. Non-recurring dividend receipts. A second item which sometimes repays scrutiny is that of dividends received. When a railroad controls subsidiary companies, it is possible to draw out accumulated profits at irregular intervals in the form of special dividends paid to the parent company. The effect of such transactions is to overstate the actual earning power of the parent company for the year in which the subsidiary's special dividend was received. Excessive maintenance and undistributed earnings of subsidiaries. Railroad reports will also disclose the opposite situation at times, viz., excessive maintenance expenditures or the existence of large current earnings of subsidiaries not paid over to the parent company. The effect of such accounting is to understate the true earning power of the carrier examined. Matters of this kind are of considerable interest in the analysis of stock values, but the bond buyer's concern with such factors is of secondary character. In general, he should not permit them to reverse an otherwise unfavorable verdict as to the safety of the bond, but he should recognize that their presence gives added attractiveness to bond issues which show adequate security without taking them into account. Analysis of low-priced railroad bonds. A study of speculatively priced railroad bonds will properly include consideration of many factors in addition to those just discussed. Under our broad principles of arrangement, consideration of this subject should be deferred to our later chapter on speculative senior securities. It seems preferable to deal with it here, however, in order not to break up our treatment of railroad bond analysis. Many bond buyers may be moved also to carry the analysis of investment issues further than we suggest is necessary, and to be guided in their selection among all eligible issues by more detailed considerations of operating, traffic, and financial statistics. More exhaustive study of a railroad bond issue falls under two headings. 1. The showing and prospects of the road as a whole, and 2. The position of the individual bond issue. Under the first division will come, in addition to the basic points already outlined, such matters as the character of the traffic and the efficiency of operation. Character of traffic. On this score, a significant change in viewpoint has been forced on the investor in the last generation. Formerly, chief emphasis was laid upon diversification of traffic and upon a liberal percentage of better-paying classes, for example, miscellaneous and less than carload lot shipments. More recent developments have proved this older viewpoint unsound. The higher rate classes of traffic have turned out to be especially vulnerable to truck competition, and some of the roads with the choicest quality of traffic have fallen behind most since 1929. At the other extreme, we find that the few consistently profitable carriers have been mainly the eastern soft coal lines, Chesapeake and Ohio, Norfolk and Western, Virginian, and to a lesser extent Western Maryland, which have concentrated on a single type of low-rate freight movement, which they have been able to handle with extraordinary economy. By contrast, the anthracite carriers have had a very disappointing and difficult time due to a severe decline in the use of hard coal because of fuel oil competition. The complete change in the relative position of the hard and the soft coal carriers between 1923 and 1938 is shown graphically in the table that may be found in the accompanying PDF. and constitutes a warning to the security buyer not to accept the present or the past as a guarantee of the future. This warning may be applicable to the soft coal roads themselves, whose prosperity could conceivably vanish as did that of the anthracite carriers. The contrast between the continuing depression in the bituminous industry and the dazzling prosperity of the soft coal carriers may have significance for the future. Because of the loss of light traffic to motor trucks and of passenger traffic to automobiles and buses, the railroads as a whole have become more dependent than formerly on heavy traffic. For example, coal, iron and steel, other minerals, stone, sand, etc. Their prosperity is more tied up than formerly with activity in the capital goods industries. Hence, taken as a whole, they are now handicapped both by a definite diminution of their average traffic and by an added degree of year-to-year variability in the traffic that remains. It is not difficult, perhaps, to obtain a clear view of the traffic situation as it has developed on the railroads generally and on the individual lines. But the application of this knowledge to the future and the selection of specific bond or stock issues based thereon is far from a simple process. It may be assumed that traffic developments to date are fully reflected in both operating results and security prices. Can the investor go further and form a dependable judgment as to what classes of business are due to suffer still greater losses to competitors, which ones are relatively immune, and which may even be built up or regained? It is undoubtedly part of the speculator's function to arrive at conclusions on such matters as these. But we must express doubt whether the facts and their implications are sufficiently definite to form a basis for what may properly be called an investment judgment. Hence, we must reiterate our view that the purchase of railroad bonds for investment must be motivated primarily by an adequate margin of safety actually demonstrated, and that expectations as to future traffic developments should play only a cautionary role. Operating efficiency. The measures of operating efficiency generally considered are the following: operating ratio, transportation ratio, average train load and car load, average car miles per day, ratio of empty mileage to total mileage, fuel consumption per locomotive mile. The operating ratio is the ratio of all operating expenses, excluding taxes, to gross revenues. The transportation ratio applies only to those costs classified as transportation expenses. In our opinion, a more useful criterion than either of these would be the ratio to gross of all operating expenses except maintenance but including taxes. This might be called the other operating expense ratio. Maintenance outlays are separated because they are generally regarded as an indication of the liberality rather than the efficiency of the management. Allowance must, of course, be made for the lower maintenance requirements of some carriers in relation to their revenues. For example, the soft coalers. Some studies may also be attempted to determine whether a given road is accomplishing a physical unit of maintenance cheaply or expensively, but this is a difficult subject on which to reach dependable conclusions. The other items are self-explanatory: a high average train load and car load, high car mileage per day, low mileage of empties, low fuel consumption are all obvious desiderata. However, the usefulness of these data is diminished by the fact that they are all pretty well reflected in the transportation ratio, so that one must beware of emphasizing the same point twice. It may also be an open question if a road making a rather poor showing in these respects may not present a more rather than a less attractive opportunity, provided these disadvantages are fully reflected in the price of its securities, since it may be easier to produce improvement in the future precisely because its performance is substandard. These observations apply also to two intermediate factors: the traffic density, ton miles carried per mile of road, and the average length of haul per ton. These figures relate to the character of the traffic, but their influence shows itself largely in the operating ratio. The specific security. As long as a road seems certain to remain solvent with ample margins to spare, all its obligations may be viewed almost as a unit, and the difference in value between one fixed value security and another is relatively minor. With the first threat of trouble, this difference begins to take on great significance. Attention is then directed, 1, to the character of the mileage securing the bond, and 2, to the order of its lien thereon. The necessity of careful study in such cases of the specific position of so-called underlying bonds and divisional liens was emphasized at the end of Chapter 6. In studies of this kind, the freight traffic density charts will prove of great value, though it must be pointed out that these are not readily accessible to ordinary analysts. Insolvent roads are frequently required to segregate the earnings and expenses applicable to the various mortgage liens to determine the contribution of each issue to the earning power of the system. Such data are usually made the basis of the treatment to be accorded these issues in the reorganization plan. Public utility bond analysis. The popularity of public utility securities between 1926 and 1929 resulted in an enormous increase in the amount of such financing, but this increased quantity was accompanied by a definite retrogression in the standards of quality and in the methods of presentation employed by the issuing houses. Investment bankers, including some of the highest reputation, followed entirely indefensible practices in their offering circulars, in order to make the issues appear safer than they actually were. Of these objectionable devices, the most important were, 1, the application of the term public utility to industrial operations, 2, the use of the prior deductions method of stating the earnings coverage, and 3, the ignoring of depreciation in calculating the net earnings available for bond interest. 1. Abuse of the term public utility. Just what constitutes a public utility enterprise may be the subject of some controversy. In its strict definition, it would be any enterprise supplying an essential service to the public, subject to the terms of a franchise and to continuous regulation by the state. While steam railroads are in fact a public utility undertaking, it is convenient and customary to place them in a separate category. From the investment standpoint, the most important idea associated with a public utility is that of stability, based first upon the rendering of an indispensable and generally exclusive service to a large number of customers, and secondly, upon the legal right to charge a rate of compensation sufficient to yield a fair return on the invested capital. It must be borne in mind that this stability is relative rather than absolute, since it is not immune from basic changes or unexpected vicissitudes. 20 years ago, the leading type of utility was the street railway, but this industry is now subject to such severe competition from other forms of local transportation that in most communities it is not practicable to set the fare high enough to return reasonable earnings on the actual investment. Furthermore, during the war inflation period of 1918 to 1920, the light and power companies suffered keenly from rising labor and material costs, together with difficulties and delays in obtaining permission to advance rates proportionately. These hardships had for a time an adverse effect upon the popularity of all utility investments, but the subsequent brilliant expansion of both gross and net earnings of gas, electric, water, and telephone companies speedily restored their securities to favor. It is to 3 of these services, viz. gas, electric, and telephone, that the utility investments of savings banks are restricted by the New York statute. We have remarked previously that this category may properly be widened to include companies supplying water to communities of substantial size. Pseudo-utilities. But in the heyday of public utility bond flotations, this popular label was used by banking houses to promote the sale of many issues which partook only partially at best of the true character of public utilities, and which may well be stigmatized as pseudo-utilities. Companies selling ice, operating taxi cabs, or owning cold storage plants became suddenly affected with a public interest, to an extent permitting them to bond themselves for the major portion of their property investment and to sell these bonds to investors as public utility securities. In most instances, the enterprises so financed represented a combination of small gas, electric, or telephone establishments with the ice or cold storage business in such a way as to confuse or mislead the public as to the true nature of the investment offered. An outstanding and unfortunate precedent for this hybrid form of organization was set many years ago by the city's service company, which combined a large bona fide public utility network with an equally large venture in the production, refining, and marketing of oil. Natural gas. The period preceding the 1929 crash was marked also by the sudden transmutation of natural gas from a branch of the oil industry into one of the country's leading public utilities. Up to that time, natural gas had been used mainly as industrial fuel and as raw material for the production of gasolines and carbon black. Improvements in pipeline construction permitted the transport of this gas over long distances to urban centers, where it replaced considerable quantities of manufactured gas. Promoters and banking houses were quick to exploit the popular appeal of this new utility, and by the use of this designation, an enormous total of natural gas bond financing was successfully foisted on the public. As in the case of the ice plants, considerable recourse was had to the device of combining a natural gas development with small bona fide utility properties. In many cases, the sale of these bonds under the guise of public utility investments was a gross abuse of the public confidence because the bulk of the natural gas output was being taken for manufacturing use and the business was subject to all the hazards of the fuel industry. The above exposition should make it plain that there are utilities and utilities, and that investors must not take stability for granted because an issue is marketed under this popular title. In particular, they should shun these hybrid mixtures of electric or telephone services with industrial activities because at bottom every such combination represents an attempt to sail under false colors. 2. Use of the prior deductions method of calculating coverage. We have already indicated the fallacy involved in the calculation of interest coverage after the deduction of prior charges. This deceptive method seems now to have been abandoned, but the investor should be on his guard against its return. Furthermore, as we point out in Chapter 15, the practice, still continued, of stating earnings on investment preferred stocks as so many dollars per share, without reference to prior interest charges, is in essence identical with the prior deductions method of stating interest coverage. 3. Omission of depreciation charges in calculating coverage. No satisfactory reason can be advanced for the formerly widespread failure of the bond offering circulars to deduct the depreciation allowance before computing the interest coverage. Depreciation is a real and vital element in the operating expense of a public utility. In the case of the typical well-established company, a good part of the annual depreciation reserve is actually expended for the renewal of worn-out or obsolete equipment, so that it cannot be claimed that depreciation is a mere bookkeeping concept which need not be taken seriously. There is naturally room for a divergence of opinion with respect to the proper amount of depreciation to charge in any situation. But if proper attention were given to the extremely important element of obsolescence, it is hardly likely that the allowance made by the typical holding company will be found excessive, and in fact it is more likely to understate the true depreciation. In the writer's opinion, the cavalier omission of depreciation charges in the statement of earnings applicable to bond interest comes perilously close to outright misrepresentation of the facts. A device fully as misleading is illustrated by the offering in 1924 of Cities, Service, Power, and Light Company 6s, due in 1944. In this case, the indenture was so drawn as to require a minimum charge for depreciation and maintenance amounting to much less than the sums actually expended and reserved by the various operating subsidiaries. In the bond prospectus, the earnings were stated after deductions for depreciation assumed at rates in the indenture securing these bonds, which in plain language meant that the true depreciation was greatly understated in calculating the margin of safety behind the bond issue. This piece of financing is commented on further below. Recommended procedure. It is emphatically recommended that the intending purchaser of a public utility bond issue make sure that a normal depreciation charge has been deducted from earnings before he accepts the reported statement of interest coverage. Based upon the reports of many such companies, it would seem that an allowance amounting to less than 10% of gross may be viewed with suspicion as probably inadequate. In fact, the conservatively minded might be justified in applying a minimum figure of 12% of gross. Depreciation actually accrues, of course, as a percentage of the property account and not of the revenues. But since there is a fairly constant relationship between the investment and the gross receipts, about $4 of property for $1 of revenue, the adequacy of the depreciation allowance may be conveniently judged by reference to the gross revenues. Examples showing need for critical examination of offering circular. The following actual example illustrates in rather extreme fashion the practices formerly followed in bankers' circulars offering public utility bonds. As may be found in the accompanying PDF, Utilities Service Company Convertible Debenture 6 1/2 due 1938, offered in 1928 at 99 1/2, yielding 6.55%. Criticism of this offering circular. 1. The business is a combination of utility, telephone, and industrial ICE operations, but it is bonded more heavily than a 100% utility enterprise could safely stand, the total debt being 84% of the appraised property value. The proportion of gross and net contributed by the ICE business is not stated and must therefore be assumed to be substantial. 2. The omission of the depreciation charge from the earnings statement is so misleading as to appear almost fraudulent. Depreciation reserves by telephone companies absorb a large percentage of gross receipts. In the case of the American Telephone and Telegraph System, this percentage averages about 15%, and the same deduction was actually made by the chief subsidiary of the Utilities Service Company, Lima Telephone Company. If depreciation at the rate of 15% of gross is charged against the total revenue, the amount so to be deducted would be $500,000 and would leave practically no earnings available for the debenture interest. In other words, instead of covering the debenture interest 2.71 times as stated, the company would be failing to earn the interest charges by a large deficit. The ICE operations would carry a smaller depreciation charge than 15% of gross, but this advantage should be offset by the greater margin of safety required for an industrial business. Furthermore, if the net valuation of $12,500,000 placed on the property is accepted, then in any event the annual depreciation deduction should not be less than 4% or $500,000. 3. The calculation of interest coverage in the circular made by the prior deductions method would indicate that the debentures were better protected than the prior liens. They earned their interest 2.71 times, while senior interest was covered 2.20 times. Assuming a low depreciation charge of $300,000 per annum and presenting the interest deductions properly, the exhibit of this bond offering would be restated as follows and may be found in the accompanying PDF. 4. The statement that there was $1,650 of property value behind each $1,000 debenture is based upon a similarly misleading method. The aggregate bonded debt was $10,500,000 against $12,500,000 of appraised value, so that the appraisal showed only $1,190 of value behind each $1,000 of total debt. Another example. It may be illuminating also to make a similar critical examination of the advertisement offering Cities Service Power and Light Company secured 6s due 1944 at 96 to yield 6.35% as published in April 1926. The earnings data covering the calendar year 1925 may be found in the accompanying PDF. Income applicable to interest charges, as shown above, was over 4.9 times maximum annual interest requirements on Series A bonds of $1,466,250 and over 4.1 times maximum annual interest charges of $1,736,250 on all outstanding funded debt of Cities Service Power and Light Company. This circular was misleading in two important respects. First, in employing the prior deductions method for computing the earnings coverage on the bonds offered, and secondly, in using an artificial and quite inadequate basis of depreciation. A study of the application to list this issue on the New York Stock Exchange shows that the operating subsidiaries actually made appropriations for replacements amounting to $5,214,000 for the year ending June 30th, 1925. This was almost 4 times the arbitrary rates set up in the indenture. A revision of the offering circular to conform with the actual situation in respect to depreciation and with the proper method of stating interest coverage may be found in the accompanying PDF. This showing is very different indeed from a coverage of 4.1 or 4.9 times interest as indicated in the offering circular. Deduction of federal taxes in computing interest coverage. The federal income tax is imposed upon profits after subtracting interest paid. Hence, earnings available for interest should properly be shown before deducting the federal tax. In corporate reports to stockholders, it is customary to reverse this order, and in many cases the amount of the tax is not shown. But in analyzing the exhibit of a bond issue, it should not be necessary to revise the income statements by adding back the federal taxes, actual or estimated. The reason is that the result produced by such revision can very rarely make enough difference to affect the apparent eligibility of the bond issue for investment. Furthermore, the error, such as it is, lies on the side of understatement, which is by no means objectionable in the selection of investment bonds. In general, the analyst should refrain from elaborate computations or adjustments which are not needed to arrive at the conclusion he is seeking. In bond offering circulars, the income available for interest is usually stated before deduction of federal tax in order to make the best showing permissible. This cannot properly be objected to except sometimes in the case of offerings of bond issues of public utility holding companies. Such bonds are usually junior to the preferred stocks of subsidiary companies, and the federal tax must be computed and deducted before these dividends are paid. Hence, objection may fairly be leveled against a presentation such as was made in the offering circular of Cities Service Power and Light debenture 5 1/2 in November 1927, wherein the earnings applicable for interest on the holding company's bonds were stated before deducting federal taxes of the system. Chapter 13. Other Special Factors in Bond Analysis. Parent company only versus consolidated return. Both bond offering circulars and annual reports almost invariably present the earnings statement of a public utility holding company system in a consolidated form. That is, they start with the gross revenues of the operating subsidiaries and carry the figures down through operating expenses, depreciation, fixed charges, and preferred dividends of subsidiaries until they arrive at the balance available for the parent company's interest charges, and finally at the amount earned on its common stock. There is also published, largely as a matter of form, the income account of the parent company only, which starts with the dividends received by it from the operating subsidiaries, and therefore does not show the latter's interest and preferred dividend payments to the public. The interest coverage shown by the income account of the parent company only is an example of the prior deductions method, and consequently it will almost always make a better showing for the parent company's bonds than will be found in the consolidated report. The investor should pay no attention to the parent company only figures and insist upon a completely consolidated income account. The following example of Standard Gas and Electric System 1931 may be found in the accompanying PDF. The parent company did not receive in dividends the full amount earned by its subsidiaries, but even with this smaller income, the prior deductions method results in a much larger indicated coverage for the parent company bond interest on the basis of its own results than on a consolidated basis. Dividends on preferred stocks of subsidiaries. In a holding company system, the preferred stocks of the important operating subsidiaries are in effect senior to the parent company's bonds, since interest on the latter is met chiefly out of dividends paid on the subsidiary's common stocks. For this reason, subsidiary preferred dividends are always included in the fixed charges of a public utility holding company system. In other words, these fixed charges consist of the following items in order of seniority. 1. Subsidiaries' bond interest. 2. Subsidiaries' preferred dividends. 3. Parent company's bond interest. This statement assumes that all the subsidiary companies are of substantially the same relative importance to the system. An individual subsidiary which happens to be unprofitable may discontinue preferred dividends and even bond interest, while at the same time the earnings of the other subsidiaries may permit the parent company to continue its own interest and dividend payments. In such a case, which is somewhat exceptional, the unprofitable subsidiaries' charges are not really senior to the parent company's securities. This point is discussed at the end of Chapter 17. The fixed charges should also properly include any annual rentals paid for leased property, which are equivalent to bond interest or guaranteed dividends. In the majority of holding company reports, this practice is followed. For example, Public Service Corporation of New Jersey. The holder of preferred shares of an important operating subsidiary has, to all intents and purposes, a claim which is as fixed and enforceable on the system's earnings as have the owners of the parent company's bonds. But if the parent company becomes insolvent, then the owners of the underlying preferred issues no longer occupy the strategic position of bondholder, since they cannot compel the operating subsidiary to continue paying its preferred dividends. Example: New York Water Service Corporation Preferred may be cited as an example. The company is an operating subsidiary of Federal Water Service Corporation, which in turn was a subsidiary of Tri-Utilities Corporation. Dividends on this issue and on Federal Water Service Preferred ranked as fixed charges of the Tri-Utilities system. When the latter company was unable to meet interest on its debentures and went into receivership in August 1931, dividends on these underlying preferred issues were promptly discontinued, although both were apparently earned, and the income of New York Water Service Corporation actually showed an increase over the previous year. Minority interest in common stock of subsidiaries. The earnings applicable to minority stock are usually deducted in the income statement after the parent company's bond interest, and hence the former item does not reduce the margin of safety as generally computed. We prefer to subtract the minority interest before calculating the interest coverage. Exact treatment would require prorating of deductions, but this involves needlessly burdensome calculations. When the minority interest is small, as is true in most cases, the difference between the various methods is inconsequential. When the minority interest is fairly large, analysis will show that the customary procedure gives a margin of safety somewhat higher than is strictly accurate, whereas our method errs moderately in the opposite direction and hence should be preferred by conservative investors. Capitalization of fixed charges for railroads and utilities. In the previous chapter, we pointed out certain difficulties in the way of arriving at a fair statement of the ratio of stock to debt in the case of railroads and public utilities. Debt may be represented not only by bond issues but also by guaranteed stocks, annual rental obligations, and effectively also by non-guaranteed preferred stocks of operating subsidiaries. In computing the interest coverage, these items are taken care of by using the omnibus figure of fixed charges instead of merely the bond interest. The principal amount of all these obligations is usually stated quite clearly in the consolidated balance sheet of a public utility enterprise, but this may not be true in the case of a railroad company, chiefly because its rental obligations are not likely to be reflected in the balance sheet. We suggest, therefore, that the true or effective debt of a railroad may be calculated by multiplying the fixed charges by an appropriate figure, say 22. This is equivalent to capitalizing the fixed charges at an assumed rate of 4.5%. In other words, to assuming that the true debt is that figure, 4.5%, on which will produce the annual fixed charges. The 4.5% figure reflects the actual current interest rate carried by railroad indebtedness as a whole in 1938. Technique illustrated. We have suggested that the earnings coverage for railroads be applied to either the net deductions or the fixed charges, as previously defined, whichever are larger. In the same way, the larger of these two items should be used as the base for computing the principal amount of the road's effective debt. The technique to be followed is illustrated herewith and may be found in the accompanying PDF. Conclusions based on foregoing. The effective debt of the New Haven was computed from the net deductions, which are larger than the fixed charges because they include a substantial debit for equipment rentals, etc. This effective debt is considerably more than that shown in the balance sheet. With the preferred and common stocks together selling in July 1933 for less than a sixth of the true debt, it is evident that the bonds had an insufficient stock equity at the time. If the prospects were considered favorable, there might be good reason to buy the common stock for larger capital appreciation, but no such possibility attached to the 6% bonds selling at 92, and consequently the purchase of this issue could not be supported by sound analysis. The Chesapeake and Ohio exhibit, on the other hand, supplies a stock value ratio which fully confirms the satisfactory showing of the earnings coverage. If the investor were satisfied with the prospects of this road, he would then be justified in buying its bonds. For example, the refunding and improvement 4.5s selling at 92.5, since these meet both quantitative tests in satisfactory fashion. The working capital factor in the analysis of industrial bonds. For reasons already explained, a company's statement of its fixed assets will not ordinarily carry much weight in determining the soundness of its bonds, but the current asset position has an important bearing upon the financial strength of nearly all industrial enterprises, and consequently the intending bond purchaser should give it close attention. It is true that industrial bonds which meet the stringent tests already prescribed will in nearly every instance be found to make a satisfactory working capital exhibit as well, but a separate check is nevertheless desirable in order to guard against the exceptional case. Current assets, termed also liquid, quick, or working assets, include cash, marketable securities, receivables, and merchandise inventory. These items are either directly equivalent to cash or are expected to be turned into cash through sale or collection in the ordinary course of business. To conduct its operations effectively, an industrial enterprise must possess a substantial excess of current assets over current liabilities, the latter being all debts payable within a short term. This excess is called the working capital or the net current assets. 3 requisites with respect to working capital. In examining the current asset situation, an industrial bond buyer should satisfy himself on 3 counts, viz. 1. That the cash holdings are ample. 2. That the ratio of current assets to current liabilities is a strong one. 3. That the working capital bears a suitable proportion to the funded debt. It is not feasible to fix definite minimum requirements for any one of these three factors, especially since the normal working capital situation varies widely with different types of enterprise. It is generally held that current assets should be at least double the current liabilities, and a smaller ratio would undoubtedly call for further investigation. We suggest an additional standard requirement for the ordinary industrial company, viz., that the working capital be at least equal to the amount of the bonded debt. This is admittedly an arbitrary criterion, and in some cases it may prove unduly severe. But it is interesting to note that in the case of every one of the industrial issues which maintained their investment rank market-wise throughout 1932, the working capital exceeded the total of bonds. In contrast with the emphasis laid upon the current asset position of industrial concerns, relatively little attention has been paid to the working capital shown by railroads, and none at all to that of public utilities. The reason for this is twofold. Neither railways nor utilities have the problem of financing the production and carrying of merchandise stocks or of extending large credits to customers. Furthermore, these companies have been accustomed to raising new capital periodically for expansion purposes, in the course of which they readily replenish their cash account if depleted. Because new financing is easily obtainable by prosperous companies of this type, even an excess of current liabilities over quick assets has not been considered a serious matter. Recent experience indicates the desirability of substantial cash holdings by a railroad to meet emergency developments, and the bond buyer might do well to favor those public utilities also which maintain a comfortable working capital position. Chapter 14. The Theory of Preferred Stocks. That the typical preferred stock represents an unattractive form of investment contract is hardly open to question. On the one hand, its principal value and income return are both limited. On the other hand, the owner has no fixed, enforceable claim to payment of either principal or income. It may be said that preferred stocks combine the limitations of creditorship, bonds, with the hazards of partnership, common stocks. Yet despite these strong theoretical objections, the preferred stock has developed into a major factor in our financial scheme and has evidently succeeded in commending itself to the American investor. In 1939, there were about 420 different preferred issues listed on the New York Stock Exchange, as against some 830 common stocks. In 1929, the value of the listed preferred shares exceeded $8.5 billion and were about half as great as that of listed corporation bonds. The verdict of the marketplace. In the subsequent market collapse, the price of these shares suffered a drastic shrinkage, an experience that was repeated on a smaller scale in 1937 to 1938. The chart entitled Average of all listed on the New York Stock Exchange may be found in the accompanying PDF. These figures establish the fact that although both bonds and preferred stocks have shown themselves vulnerable to adverse conditions, there can be no doubt that preferred stocks as a whole are subject to the greater percentage decline. Certainly a contrast exists between the theoretical weakness plus the unsatisfactory performance of preferred stocks on the one hand, and their widespread popular acceptance on the other. A thoroughgoing analysis would seem to be called for in order to determine the true merits of preferred shares as a practical medium of investment. Basic difference between preferred stocks and bonds. The essential difference between preferred stocks and bonds is that payment of preferred dividends is entirely discretionary with the directors, whereas payment of bond interest is compulsory. Preferred dividends must indeed be paid as long as any disbursements are being made on the common shares. But since directors have the power to suspend common dividends at any time, the preferred stockholder's right to income is at bottom an entirely contingent one. However, if a company's earnings are regularly far in excess of preferred dividend requirements, payment is usually made as a matter of course, and in such instances, the absence of an enforceable claim to dividends does not seem to be of real importance. This explains the existence of a relatively small number of high-grade preferred issues which are considered equivalent in quality to sound bonds and sell at comparable prices. At the opposite extreme are the cases in which corporations are unable to pay anything, whether it be on bonds or on preferred stock. In such situations, the bondholder's legal right to receive interest results not in payment, but in bankruptcy. As we have previously pointed out, the practical value of this remedy is doubtful, and in most instances it may fairly be said that the position of a bond in default is little better than that of a non-dividend paying preferred stock without bonds ahead of it. At both extremes, therefore, the contractual superiority of bonds over preferred stocks is not of substantial value. This fact has led many investors to believe that, as a general rule, the bond form has no real advantage over the preferred stock form. Their line of reasoning runs: if the company is good, its preferred stock is as good as a bond, and if the company is bad, its bonds are as bad as a preferred stock. Weakness because of the discretionary right to omit dividends. This point of view is highly inexact because it fails to take into account the wide middle region occupied by companies neither unqualifiedly good nor unqualifiedly bad, but subject to variations and uncertainties in either direction. If it could be assumed that directors will always pay preferred dividends when possible, and hence will suspend payment only under conditions which would compel default of interest if the issue were a bond, then, even in the intermediate situations, the preferred stockholder's status would not be greatly inferior to the bondholders. But in actual fact, this is not the case, because directors frequently exercise their discretion to withhold preferred dividends when payment is by no means impossible but merely inconvenient or inexpedient. It is considered an approved financial policy to sacrifice the preferred stockholder's present income to what he is told is his future welfare. In other words, to retain cash available for dividends in the Treasury to meet future emergencies or even for future expansion. Even if it be conceded that such a practice may ultimately be advantageous to the preferred stockholder, the fact remains that it subjects his income to a hazard not present in the case of a similarly situated bond. If such a hazard is at all substantial, it automatically disqualifies the preferred issue as a fixed value investment because it is the essence of such investments that the income must be considered entirely dependable. Stating the point more concretely, any preferred stock subject to a real danger of dividend reduction or suspension will fluctuate widely in market value. It is a point worth noting that in all cases where the dividend could be continued, but instead is withheld for the sake of the stockholder's future advantage, the quoted price suffers a severe decline, indicating that the investment market does not agree with the directors as to what is really in the best interests of the preferred stockholders. Conflicts of interest. Nearly every investor would rather have his income continued, even at possible risk to the future of the business. There is evidently a basic disagreement, amounting almost to a logical contradiction, between what the investor considers to be his individual advantage, viz., the continuance of his income at all costs, and what he seems willing to admit may be sound corporate policy, viz., the suspension of dividends for the sake of the future. In this connection, the question of a possible conflict of interest between the preferred and the common stockholders is of undoubted importance. Withholding preferred dividends may be of distinct advantage to the common stock. The directors are legally required to represent the interests of all stockholders impartially, but since, in fact, they are most often elected by the common stockholders, they tend to act primarily in the latter's behalf. Directors have also grown accustomed to consider the interests of the enterprise itself as an entity apart from the interests of its owners, that is, the stockholders, and they frequently pursue policies with the apparent purpose and result of strengthening the corporation at the actual expense of its proprietors. This paradoxical viewpoint may perhaps be explained in part by the customary close connection between corporate directors and the salary-drawing officers. Form of preferred contract often entails real disadvantage. Whatever the reason or justification may be, the fact remains that preferred stockholders are subject to the danger of interruption of dividend payments under conditions which would not seriously threaten the payment of bond interest. This means that the form of the preferred stockholder's contract will often entail a real disadvantage. Example: a striking illustration of this fact is afforded by the case of United States Steel Corporation Preferred, which is probably the largest senior stock issue in the world and was for many years thoroughly representative of those preferred shares which enjoyed a high investment rating. In 1931, although the Depression was well advanced, this issue sold at a price to yield only 4.67%, and it was thought to occupy an impregnable position as a result of the accumulation of enormous sums out of the earnings during the preceding 30 years and their application to the improvement of manufacturing facilities, the enlargement of working capital, and the retirement of nearly all the bonded debt. Yet immediately thereafter, a single year of operating losses jeopardized the preferred dividend to such an extent as to destroy nearly two-thirds of its market price and undermine completely its standing as a prime investment. In the following year, the dividend was reduced to $2 annually. These disastrous developments were due, of course, to the unprecedented losses of 1932 to 1933. But if it had not been for the weakness of the preferred stock form, the holder of these shares would have had little reason to fear the discontinuance of his income. In other words, if he had possessed a fixed claim for interest instead of a contingent claim for dividends, he could have relied with confidence on the corporation's enormous resources to take care of its obligations. In support of this contention, a brief comparison is appended of the market action of Inland Steel 4.5s, previously discussed, with that of United States Steel Preferred. Both of these issues were subject to the same adverse business conditions, but the contractual weakness of United States Steel Preferred was responsible for the loss of an investment position which the Inland bonds were able to retain without serious difficulty, except for a brief period of utter demoralization in the bond market. Voting rights, a potential safeguard but generally ineffective. The contractual weakness of preferred stocks as compared with bonds might be greatly reduced if preferred stockholders were to exercise effective voting control over the enterprise as soon as either dividends or sinking fund were suspended. We shall point out in later chapters on protective provisions that such voting control, properly exercised, might constitute the best protective and remedial arrangement for both bonds and preferred stock. This would imply that, given suitable protective provisions intelligently availed of, the practical position of bondholders and preferred shareholders would not be significantly different. In our opinion, a good part of the present very real inferiority of preferred stocks to bonds is ascribable to the failure of preferred stockholders either to obtain voting control promptly or to exercise it intelligently after dividends are suspended. However, our analysis of the investment status of preferred stocks must be predicated on the undoubted fact that, with conditions as they are, the individual holder of preferred shares cannot rely upon his voting rights to achieve full protection of his interests. Yield and risk. Returning to the actual performance of preferred issues in the last decade, their unsatisfactory record as a class may well raise the question if they should not be completely avoided as a medium of fixed value investment. But in rebuttal, it may be pointed out that a small number of preferred issues maintained an investment rating even at the worst moments of 1932, and a much larger number during the severe recession of 1938. The proponents of preferred shares will contend, moreover, that under normal variations in business conditions, the higher yield of this group will compensate for such inferiority as exists in their safety as compared with bonds. This is an argument which always appeals to the investor in good times, when the increased income is an actuality and the risk to principal seems a remote contingency. In bad times, there is perhaps an opposite disposition to consider only the shrinkage of principal suffered and to forget about the higher income received in the years preceding. To present a broader view of this question, we revert to our previous discussion of bonds with varying degrees of safety, in which we arrived at the principle that risk and income return are at bottom incommensurable. If this statement is valid for bonds, it must apply with equal force to preferred stocks. This means that it is not sound procedure to purchase a preferred stock at an investment price, for example, close to par, when the presence of a substantial risk to principal is recognized, but when this risk is expected to be offset by an attractive dividend return. It would follow from this principle that the only preferred stock which can properly be bought for investment would be one which, in the purchaser's opinion, carries no appreciable risk of dividend suspension. Qualification of high-grade preferred stocks. What must be the qualifications of such a preferred stock? In the first place, it must meet all the minimum requirements of a safe bond. In the second place, it must exceed these minimum requirements by a certain added margin to offset the discretionary feature in the payment of dividends. That is, the margin of safety must be so large that the directors may always be expected to declare the dividend as a matter of course. Thirdly, the stipulation of inherent stability in the business itself must be more stringent than in the case of a bond investment, because a company subject to alternations between large profits and temporary losses is likely to suspend preferred dividends during the latter periods, even though its average earnings may far exceed the annual requirements. The foregoing reasoning suggests conclusions that correspond to the actual behavior of preferred shares in 1932 to 1933. These conclusions are not that preferred stocks must, per se, be excluded from the investment category, but rather that such severe specific requirements must be imposed upon them as to make the number of eligible issues comparatively small. The list that may be found in the accompanying PDF comprises all of the preferred stocks listed on the New York Stock Exchange which maintain a price equal to a 7% return or less at all times during 1932 and 1933. There are appended also certain quantitative data bearing on the degree of safety enjoyed by each of these issues. Sound preferred issues exceptional. This list of preferred stocks comprises only 5% of the total number of issues listed on the New York Stock Exchange in 1932. This small percentage bears out our thesis that a sound preferred stock, while not an impossibility, is an exceptional phenomenon. It may be called exceptional not only in the numerical sense, but also from a more theoretical standpoint. In practically every instance in the above list, the preferred stock could have been replaced by a bond issue without affecting in any material degree the soundness of the corporation's capital structure. This means that the company itself derived no important advantage through having preferred stock outstanding instead of bonds, and, on the other hand, it suffered important disadvantages through income tax liability and also because of the higher cost of its senior capital. Stating the matter differently, in order that a preferred stock may be thoroughly sound, the burden it imposes must be so light that the company may just as readily carry that burden in the form of a bond obligation. We are led, therefore, to the final conclusion that not only are sound preferred stocks exceptional, but in a certain sense they must be called anomalies or mistakes, because they are preferred issues which should really be outstanding as bonds. Hence, the preferred stock form lacks basic justification from an investment standpoint in that it does not offer mutual advantages to both the issuer and the owner. Wherever the issuing business derives a real benefit from its discretionary right to suspend dividends, then the owner does not possess a fixed value investment, and conversely, when the issue is a high-grade one, then the issuer derives no such benefit. High-grade preferred stocks, usually seasoned issues. In support of the above conclusion, it should be observed that high-grade industrial preferred issues have almost always reached this position as the result of many years of prosperous growth by the corporation after the preferred stock was first created. Exceedingly few preferred shares are so strongly entrenched at the time of original sale as to meet the stringent requirements needed for full investment rating. For when a corporation is able to make as strong a showing as we require, it will nearly always prefer to do its financing through a relatively small bond issue at a low interest rate and with substantial income tax saving. This does not apply to the public utility companies since, for reasons probably related to the legal investment status of their bond issues, they prefer to carry a portion of their senior financing in the form of stock. Thus, 4 of the 5 high-grade utility preferred stocks included in the above list were floated in recent years. But the industrial preferred shares in this list present an entirely different picture. Only 1 out of the 15 issues was actually sold to the public within the past 20 years, and even this exception, Procter & Gamble Company 5% preferred, was floated to replace an older preferred issue at a lower dividend rate. The General Electric Company senior shares were the result of a stock dividend plan, but the 13 other issues originated long ago and owe their investment status to the prosperous years which followed. Preferred stock financing 1935 to 1938. Our view that the preferred stock form lacks inherent logic must be advanced with the caveat that it is not shared by investment bankers. New financing in recent years has included a sizable number of preferred stock offerings. Many of these have been privileged issues, convertibles, etc., and as such, fall outside the present discussion. But there have also been flotations of straight industrial preferreds, at least 8 such new issues having been listed on the New York Stock Exchange between 1935 and 1938. All but one of these would have met our stringent tests of safety, and hence they could not be objected to as insecure. But in our opinion, they might just as well or better have been floated as bonds. Origin of the popularity of preferred stocks. At the beginning of this discussion, we referred to the prominent role that preferred stocks have played in financing American corporations. But if our subsequent analysis is correct in concluding that this form of straight investment is fundamentally unsound, it may be asked why this unsoundness was not long ago convincingly demonstrated by the actual experience of investors. The answer is that the great popularity of preferred stocks developed during a 15-year period which rather accidentally favored the typical preferred stockholder against the typical bondholder. At the beginning of this period, just before the World War, the majority of preferred stocks were industrial issues, and most of these were admittedly speculative in character, selling at substantial discounts from par. The tremendous prosperity and growth of our larger enterprises during the war and during the years subsequent to 1922 effected a great improvement in the status and hence in the market price of many of the leading industrial preferred stocks. Within the same time, railroad and traction obligations, which constituted the main portion of the bond list, were subjected to influences of a generally adverse character. Investors, observing that the typical preferred stock was behaving better than the typical bond, drew the natural but erroneous inference that preferred stocks in general were intrinsically as sound as bonds. Poor record shown by extensive study of preferred issues. More detailed investigation will show that the popularity of preferred stocks rested upon the excellent performance of a comparatively small number of old, established, and prominent industrial issues. During the latter part of the period under review, the much more numerous new flotations of industrial preferred stocks sold on the strength of this very popularity did not fare so well. A study was made under the direction of the Harvard School of Business Administration, covering all the new preferred stock offerings from January 1, 1915 to January 1, 1920, which ranked between $100,000 and $25 million in size, 607 issues in all. This showed that the average price of 537 issues for which quotations were obtainable on January 1, 1923, had declined to a figure 28.8% below the original offering price, from 99 to 70.5, so that their purchasers had suffered a shrinkage in principal greater than the total income received. The conclusions drawn from this inductive study were highly unfavorable to preferred stocks as a form of straight investment. A more recent study. A more recent investigation published by the Bureau of Business Research of the University of Michigan leads its author to a quite different opinion. His tests of preferred stocks preceded by bond issues, both railroad and industrial, indicate clearly that senior shares of this type do not offer a satisfactory medium of investment. But with respect to industrial preferred stocks not preceded by bonds, the author's tests bring him to the opposite conclusion. Of these, he asserts that they appear to meet the most exacting investment tests, and also that diversified investment in such issues would seem to provide both a degree of safety for principal and an income return greater than that achieved by industrial or railroad bonds. The deduction that it is better to buy preferred stocks without rather than with bonds ahead of them is undoubtedly sound, since the latter group is clearly more vulnerable to adverse developments. But in our view, the methods followed in this investigation are open to certain objections that greatly diminish the practical value of its other conclusions. One feature of the study, however, deserves particular comment. The detailed figures show in striking fashion that the stability of nearly every preferred stock considered was directly dependent upon an increase in the value of the common stock. The preferred stockholder had a satisfactory investment only while the common stock was proving a profitable speculation. As soon as any common stock declined in market value below the original price, the preferred shares did likewise. An investment subject to such conditions is clearly unwise. It is a case of heads, the common stockholder wins; tails, the preferred stockholder loses. One of the basic principles of investment is that the safety of a security with limited return must never rest primarily upon the future expansion of profits. If the investor is positive that this expansion will take place, he should obviously buy the common stock and participate in its profits. If, as must usually be the case, he cannot be so certain of future prosperity, then he should not expose his capital to a risk of loss by buying the preferred stock without compensating opportunities for enhancement. Chapter 15. Technique of selecting preferred stocks for investment. Our discussion of the theory of preferred stocks led to the practical conclusion that an investment preferred issue must meet all the requirements of a good bond with an extra margin of safety to offset its contractual disadvantages. In analyzing a senior stock issue, therefore, the same tests should be applied as we have previously suggested and described with respect to bonds. More stringent requirement suggested. In order to make the quantitative tests more stringent, some increase is needed in the minimum earnings coverage above that prescribed for the various bond groups. The criteria we propose are as follows. Minimum average earnings coverage. Class of enterprise, public utilities. For investment bonds, 1 3/4 times fixed charges. For investment preferred stocks, 2 times fixed charges plus preferred dividends. Class of enterprise, railroads. For investment bonds, 2 times fixed charges. For investment preferred stocks, 2.5 times fixed charges plus preferred dividends. Class of enterprise, industrials. For investment bonds, 3 times fixed charges. For investment preferred stocks, 4 times fixed charges plus preferred dividends. These increases in the earnings coverage suggest that a corresponding advance should be made in the stock value ratio. It may be argued that since this is a secondary test, it is hardly necessary to change the figure. But consistency of treatment would require that the minimum stock value coverage be raised in some such manner as shown in the table on page 191 found in the accompanying PDF. The margins of safety above suggested are materially higher than those hitherto accepted as adequate, and it may be objected that we are imposing requirements of unreasonable and prohibitive stringency. It is true that these requirements would have disqualified a large part of the preferred stock financing done in the years prior to 1931, but such severity would have been of benefit to the investing public. A general stabilization of business and financial conditions may later justify a more lenient attitude towards the minimum earnings coverage, but until such stabilization has actually been discernible over a considerable period of time, the attitude of investors towards preferred stocks must remain extremely critical and exacting. Mere presence of funded debt does not disqualify preferred stocks for investment. It is proper to consider whether an investment rating should be confined to preferred stocks not preceded by bonds. That the absence of funded debt is a desirable feature for a preferred issue goes without saying. It is an advantage similar to that of having a first mortgage on a property instead of a second mortgage. It is not surprising, therefore, that preferred stocks without bonds ahead of them have, as a class, made a better showing than those of companies with funded debt. But from this rather obvious fact, it does not follow that all preferred stocks with bonds preceding are unsound investments, any more than it can be said that all second mortgage bonds are inferior in quality to all first mortgage bonds. Such a principle would entail the rejection of all public utility preferred stocks, since they invariably have bonds ahead of them, although these are better regarded as a group than are the non-bonded industrial preferreds. Furthermore, in the extreme test of 1932, a substantial percentage of the preferred issues which held up were preceded by funded debt. To condemn a powerfully entrenched security such as General Electric preferred in 1933 because it had an infinitesimal bond issue ahead of it would have been the height of absurdity. This example should illustrate forcibly the inherent unwisdom of subjecting investment selection to hard and fast rules of a qualitative character. In our view, the presence of bonds senior to a preferred stock is a fact which the investor must take carefully into account, impelling him to greater caution than he might otherwise exercise. But if the company's exhibit is sufficiently impressive, the preferred stock may still be accorded an investment rating. Total deductions basis of calculation recommended. In calculating the earnings coverage for preferred stocks with bonds preceding, it is absolutely essential that the bond interest and preferred dividend be taken together. The almost universal practice of stating the earnings on the preferred stock separately, in dollars per share, is exactly similar to, and as fallacious as, the prior deductions method of computing the margin above interest charges on a junior bond. If the preferred stock issue is much smaller than the funded debt, the earnings per share will indicate that the preferred dividend is earned more times than is the bond interest. Such a statement must either have no meaning at all, or else it will imply that the preferred dividend is safer than the bond interest of the same company, an utter absurdity. See the examples on the accompanying PDF. The West Penn Electric Company Class A stock is in reality a second preferred issue. In this example, the customary statement makes the preferred dividend appear safer than the bond interest, and because the Class A issue is small, it makes this second preferred issue appear much safer than either the bonds or the first preferred. The correct statement shows that the Class A requirements are covered 1.26 times instead of 7.43 times, a tremendous difference. The erroneous method of stating the earnings coverage was probably responsible in good part for the high price at which the Class A shares sold in 1937, $108. It is interesting to observe that although the Class A shares had declined to 25 in 1932, they later sold repeatedly at a higher price than the 7% preferred issue. Evidently, some investors were still misled by the per-share earnings figures and imagined the second preferred safer than the first preferred. An apparent contradiction explained. Our principles of preferred dividend coverage lead to an apparent contradiction, viz., that the preferred stockholders of a company must require a larger minimum coverage than the bondholders of the same company, yet by the nature of the case the actual coverage is bound to be smaller. For in any corporation, the bond interest alone is obviously earned with a larger margin than the bond interest and preferred dividends combined. This fact has created the impression among investors and some writers that the tests of a sound preferred stock may properly be less stringent than those of a sound bond. But this is not true at all. The real point is that where a company has both bonds and preferred stock, the preferred stock can be safe enough only if the bonds are much safer than necessary. Conversely, if the bonds are only just safe enough, the preferred stock cannot be sound. This is illustrated by two examples as follows. The Leggett and Myers preferred dividend coverage, including of course the bond interest as well, is substantially above our suggested minimum of 4 times. The bond interest coverage alone is therefore far in excess of the smaller minimum required for it, viz. 3 times. On the other hand, the Commonwealth and Southern fixed charge coverage in 1930 was just about at the proposed minimum 1 3/4 times. This meant that while the various bonds might qualify for investment, the 6% preferred stock could not possibly do so, and the purchase of that issue at a price above par in 1930 was an obvious mistake. Dollars per share formula misleading. When a preferred stock has no bonds ahead of it, the earnings may be presented either as so many dollars per share or as so many times dividend requirements. The second form is distinctly preferable for 2 reasons. The more important one is that the use of the dollars per share formula in cases where there are no bonds is likely to encourage its use in cases where there are bonds. Security analysts and intelligent investors should make special efforts to avoid and decry this misleading method of stating preferred dividend coverage, and this may best be accomplished by dropping the dollars per share form of calculation entirely. As a second point, it should be noted that the significance of the dollars earned per share is dependent upon the market price of the preferred stock. Earnings of $20 per share would be much more favorable for preferred issue selling at $80 than for preferred selling at $125. In the one case, the earnings are 25%, and in the other, only 16% on the market price. The dollars per share figure loses all comparative value when the par value is less than $100 or when there is no par stock with a low dividend rate per share. Earnings of $18.60 per share in 1931 on S.H. Kress and Company 6% preferred, par $10, are of course far more favorable than earnings of $20 per share on some 7% preferred stock, par $100. Calculation of the stock value ratio. The technique of applying this test to preferred stocks is in all respects similar to that of the earnings coverage test. The bonds, if any, and the preferred stock must be taken together, and the total compared with the market price of the common stock only. When calculating the protection behind a bond, the preferred issue is part of the stock equity. But when calculating the protection behind the preferred shares, the common stock is now, of course, the only junior security. In cases where there are both a first and second preferred issue, the second preferred is added to the common stock in calculating the equity behind the first preferred. Should the market value of the common stock be compared with the par value or the market value of the preferred? In the majority of cases, it will not make any vital difference which figure is used. There are, however, an increasing number of no par value preferreds, and also a number like Island Creek Coal Company preferred and Remington Rand, Inc. second preferred, in which the real par is entirely different from the stated par. In these cases, an equivalent would have to be constructed from the dividend rate. Because of such instances, and also those where the market price tends to differ materially from the par value, for example, Norfolk and Western Railway Company 4% preferred in 1932, or Eastman Kodak 6% preferred in 1939, it would seem the better rule to use the market price of preferred stocks regularly in computing stock value ratios. On the other hand, the regular use of the face value of bond issues rather than the market price is recommended because it is much more convenient and does not involve the objections just discussed in relation to preferred shares. Non-cumulative issues. The theoretical disadvantage of a non-cumulative preferred stock as compared with a cumulative issue is very similar to the inferiority of preferred stocks in general as compared with bonds. The drawback of not being able to compel the payment of dividends on preferred stocks generally is almost matched by the handicap in the case of non-cumulative issues of not being able to receive in the future the dividends withheld in the past. This latter arrangement is so patently inequitable that new security buyers, who will stand for almost anything, object to non-cumulative issues, and for many years new offerings of straight preferred stocks have almost invariably had the cumulative feature. Non-cumulative issues have generally come into existence as the result of reorganization plans in which old security holders have been virtually forced to accept whatever type of security was offered them. But in recent years, the preferred issues created through reorganization have been preponderantly cumulative, though in some cases this provision becomes operative only after a certain interval. Austin, Nichols & Company $5 preferred, for example, was issued under a readjustment plan in 1930 and became cumulative in 1934. National Department Stores preferred, created in 1935, became fully cumulative in 1938. Chief objection to non-cumulative provision. One of the chief objections to the non-cumulative provision is that it permits the directors to withhold dividends even in good years, when they are amply earned, the money thus saved inuring to the benefit of the common stockholders. Experience shows that non-cumulative dividends are seldom paid unless they are necessitated by the desire to declare dividends on the common, and if the common dividend is later discontinued, the preferred dividend is almost invariably suspended soon afterwards. Example: St. Louis-San Francisco Railway Company affords a typical example. No dividends were paid on the old preferred issue between 1916 and 1924, although the dividend was fully earned in most of these years. Payments were not commenced until immediately before dividends were initiated on the common, and they were continued on the new preferred less than a year after the common dividend was suspended in 1931. The manifest injustice of such an arrangement led the New Jersey courts, in the United States cast iron pipe case, to decide that if dividends are earned on a non-cumulative preferred stock but not paid, then the holder is entitled to receive such amounts later before anything can be paid on the common. This meant that in New Jersey a non-cumulative preferred stock was given a cumulative claim on dividends to the extent that they were earned. The United States Supreme Court, however, handed down a contrary decision in the Wabash Railway case, holding that, while the non-cumulative provision may work a great hardship on the holder, he has nevertheless agreed thereto when he accepted the issue. This is undoubtedly sound law, but the inherent objections to the non-cumulative provision are so great, chiefly because of the opportunity it affords for unfair policies by the directors, that it would seem to be advisable for the legislatures of the several states to put the New Jersey decision into statutory effect by prohibiting the creation of completely non-cumulative preferred stocks, requiring them to be made cumulative at least to the extent that the dividend is earned. This result has been attained in a number of individual instances through insertion of appropriate charter provisions. Features of the list of 21 preferred issues of investment grade. Out of some 440 preferred stocks listed on the New York Stock Exchange in 1932, only 40, or 9%, were non-cumulative. Of these, 29 were railroad or street railway issues and only 11 were industrial issues. The reader will be surprised to note, however, that out of only 21 preferred stocks selling continuously on an investment basis in 1932, no less than 4 were non-cumulative. Other peculiarities are to be found in this favored list, and they may be summarized as follows. 1. Both the number of non-cumulative issues and the number of preferred stocks preceded by bonds are proportionately higher among the 21 good companies than in the stock exchange list as a whole. 2. The industry best represented is the snuff business with 3 companies. 3. Miscellaneous peculiarities. A. Only one issue has a sinking fund provision. B. One issue is a second preferred, Procter & Gamble. C. One issue has a par value of only $1, Island Creek Coal. D. One issue was callable at close to the lowest market price of 1932 to 1933, General Electric. Matters of form, title, or legal right relatively immaterial. We trust that no overzealous exponent of the inductive method will conclude from these figures either 1. That non-cumulative preferreds are superior to cumulative issues, or 2. That preferreds preceded by bonds are superior to those without bonds, or 3. That the snuff business presents the safest opportunity for investment. The real significance of these unexpected results is rather the striking confirmation they offer to our basic thesis that matters of form, title, or legal right are relatively immaterial, and that the showing made by the individual issue is of paramount importance. If a preferred stock could always be expected to pay its dividend without question, then whether it is cumulative or non-cumulative would become an academic question solely, in the same way that the inferior contractual rights of a preferred stock, as compared with a bond, would cease to have practical significance. Since the dividend on United States Tobacco Company preferred was earned more than 16 times in the Depression year 1931, and since, moreover, the company had been willing to buy in a large part of the preferred issue at prices ranging up to $125 per share, the lack of a cumulative provision caused the holders no concern at all. This example must, of course, be considered as exceptional, and as a point of practical investment policy, we should suggest that no matter how impressive may be the exhibit of a non-cumulative preferred stock, it would be better to select a cumulative issue for purchase in order to enjoy better protection in the event of unexpected reverses. Amount rather than mere presence of senior obligations important. The relatively large number of companies in our list having bonds outstanding is also of interest, as demonstrating that it is not the mere presence of bonds, but rather the amount of the prior debt which is of serious moment. In 3 cases, the bonds were outstanding in merely a nominal sum, as the result of the fact that nearly all of these companies had a long history, so that some of them carried small residues of old bond financing. By a coincidence, all 3 of the non-cumulative industrial preferred stocks in our list belong to companies in the snuff business. This fact is interesting, not because it proves the investment primacy of snuff, but because of the strong reminder it offers that the investor cannot safely judge the merits or demerits of a security by his personal reaction to the kind of business in which it is engaged. An outstanding record for a long period in the past, plus strong evidence of inherent stability, plus the absence of any concrete reason to expect a substantial change for the worse in the future, afford probably the only sound basis available for the selection of a fixed value investment. The miscellaneous peculiarities in our list, mentioned under 3 above, are also useful indications that matters of form or minor drawbacks have no essential bearing on the quality of an investment. Chapter 16. Income Bonds and Guaranteed Securities. 1. Income bonds. The contractual position of an income bond, sometimes called an adjustment bond, stands midway between that of a straight bond and a preferred stock. Practically all income obligations have a definite maturity, so that the holder has an unqualified right to repayment of his principal on a fixed date. In this respect, his position is entirely that of the ordinary bondholder. However, it should be pointed out that income bonds are almost always given a long maturity date, so that the right of repayment is not likely to be of practical importance in the typical case studied. In fact, we have discovered only one instance of income bondholders actually having received payment of their principal in full by reason of maturity. Interest payment, sometimes wholly discretionary. In the matter of interest payments, some income bonds are almost precisely in the position of a preferred stock because the directors are given practically complete discretion over the amounts to be paid to the bondholders. The customary provisions require that interest be paid to the extent that income is available, but many indentures permit the directors to set aside whatever portion of the income they please for capital expenditures or other purposes before arriving at the available balance. In the case of the Green Bay and Western Railroad Company income debentures, Series B, the amounts paid out between 1922 and 1931, inclusive, aggregated only 6%, although the earnings were equal to only slightly less than 22%. The more recent indentures, for example, Colorado Fuel and Iron Company Income 5s due 1970, tend to place definite limits on the percentage of earnings which may be withheld in this manner from the income bondholders, but a considerable degree of latitude is usually reserved to the directors. It may be said that individual income bond issues may be found illustrating almost every step in the range of variation between straight preferred stocks and ordinary bonds. Low investment rating of income bonds as a class. Since the contractual rights of income bonds are always more or less superior to those of preferred stocks, it might be thought that a greater proportion of income bonds than of preferred stocks would deserve an investment rating. Such is not the case, however. In fact, we know of only one income obligation which has maintained an investment standing continuously over any length of time, viz., Atchison, Topeka, and Santa Fe Railway Company Adjustment 4s due 1995. We have here a contrast between theory and actuality. The reason being, of course, that income bonds have been issued almost exclusively in connection with corporate reorganizations and have therefore been associated with companies of secondary credit standing. The very fact that the interest payments are dependent on earnings implies the likelihood that the earnings may be insufficient. Preferred stock dividends are equally dependent upon earnings, but the same implication is not associated with them. Hence, the general investment status of income bonds as a class is seen to have been governed by the circumstances under which they are created, rather than by the legal rights which attach to them. To use an analogy, if it had been the general practice here, as in England, to avoid mortgage bond issues wherever possible, using them only where doubtful credit made this protection necessary, then we might find that mortgage bonds in general would occupy an investment position distinctly inferior to that of debenture bonds. Increased volume of income bonds probable. Looking forward, it may be true that in the future income obligations will show a larger proportion of investment issues than will be found among preferred stocks. The numerous reorganizations growing out of the 1930 to 1933 Depression and the continued weakness of railway earnings have created a large new crop of income bonds, and some of these companies may later so improve their position as to place their income obligations in the investment class, as happened to the Atchison, Topeka, and Santa Fe after its reorganization in 1895. There is also the point, so far almost overlooked, that income bonds effect a substantial saving in corporation taxes as compared with preferred stocks without important offsetting disadvantages. Some strong companies may someday be led to replace their present preferred stocks or to do their new financing by income obligations for the sake of this tax saving, in the same way as they are now creating artificially low par values for their shares to reduce the transfer taxes thereon. A development of this kind in the future might result in a respectable number of income bond issues deserving to rank as fixed value investments. Calculations of margins of safety for income bonds. The technique of analyzing an income bond exhibit is identical with that for a preferred stock. Computations of earnings on the issue taken separately must, of course, be rigorously avoided, although such calculations are given by the statistical agencies. We suggest that the minimum earnings coverage recommended in the preceding chapter for preferred stocks be required also for income bonds when selected as fixed value investments. Example: the following analysis of the Missouri, Kansas, Texas Railroad Company income account for 1930 will illustrate the proper method of dealing with all the senior securities of a company having adjustment bonds. It also shows how the two methods of figuring the fixed charges of a railroad system are to be applied to the analysis of income bonds and preferred stock. Note that interest on income or adjustment bonds is not part of the total interest charges when calculating the coverage for the fixed interest bonds. In this respect, the position of an income bond is exactly that of a preferred stock. Note also that the statement made by the statistical services that 57.29% was earned on the MKT adjustment 5s, that is, that the interest was covered more than 11 times, is valueless or misleading. Significance of these figures for the investor in early 1931. The 1930 earnings were somewhat lower than the 10-year average and could then apparently be viewed as a fair indication of the normal earning power of MKT. The coverage for the preferred stock was clearly inadequate from any investment standpoint. The coverage for the adjustment bond interest on the more conservative basis, the net deductions method, was below our minimum requirement of 2.5 times, so that this issue would not have qualified for investment. The coverage for the fixed bond interest was substantially above our minimum and indicated a satisfactory degree of protection. Naturally, the disastrous decline of earnings in 1931 to 1933 could not have been foreseen or fully guarded against. The market price of MKT fixed obligations suffered severely in 1932, but since the company's debt structure was relatively conservative, it did not come so close to insolvency as the majority of other carriers. In fact, the 1932 to 1934 interest was paid on the adjustment bonds, although such payment was not obligatory. Subsequent developments are worth describing because of their practical bearing on bond investment. The following table on fixed value investments, found in the accompanying PDF, should prove instructive. It will be seen that the 1930 earnings did not, in fact, prove a guide to the future normal earning power of MKT. Yet this mistake need not have proved very costly to an individual investor who bought the fixed interest bonds in 1931. Despite the decline in earnings and investment quality, he had several opportunities to sell out advantageously during the next 6 years. As we point out later, Chapter 21, proper investment technique would have compelled such a sale in view of the changed exhibit. After 1934, interest on the adjustment bonds was paid only in 1937. The price range of that issue is interesting chiefly as a reflection of the heedlessness of bond buyers. Note that at the 1937 highs, they paid the same price for the adjustment 5s as for the 4.5s, despite the totally inadequate earnings coverage, and despite the fact that in 1932, 1934, and 1935, the senior issue had sold more than twice as high as the adjustments. Senior income bonds. There are a few instances of income bonds which are senior in their lien to other bonds bearing fixed interest. The Atchison Adjustment 4s are the best-known example, being followed by 4% fixed interest debenture issues, which have regularly sold at a lower price, except briefly in 1938. The situation holds true also with respect to the St. Louis Southwestern Railway Company's second income 4s. While the theoretical status of such bonds is rather confusing, the practical procedure called for is, obviously, to treat the interest thereon as part of the company's fixed charges when dealing with the system as a whole. 2. Guaranteed issues. No special investment quality attaches to guaranteed issues as such. Inexperienced investors may imagine that the word guaranteed carries a positive assurance of safety, but needless to say, the value of any guarantee depends strictly upon the financial condition of the guarantor. If the guarantor has nothing, the guarantee is worthless. In contrast with the attitude of the financial novice, Wall Street displays a tendency to underestimate the value of a guarantee, as shown by the lower prices often current for guaranteed issues in comparison with the debentures or even the preferred stock of the guarantor. This sophisticated distrust of guarantees dates back to the Conaha and Hocking Coal and Coke Company case in 1915, when the Guarantor Railroad endeavored to escape its liability by claiming that the guarantee, made in 1901, was beyond its corporate powers and hence void. This attempt at evasion, encouraged by the outcome of antitrust suits in the Ohio and federal courts, in the end proved completely unsuccessful, but it cast a shadow over the value of all guarantees from which they have not completely emerged even after 25 years. We know of no important case in which a solvent company has escaped the consequences of its guarantee through legal technicalities. Status of guaranteed issues. If a company guarantees interest, dividend, or principal payments, its failure to meet this obligation will expose it to insolvency. The claim against the guarantor ranks equally with an unsecured debt of the company, so that guaranteed issues deserve the same rating as a debenture bond of the guarantor and a better rating than its preferred stock. A guaranteed issue may also be entitled to an investment rating because of its own position and earning power independent of the guarantee. In such cases, the guarantee may add to its security, but it cannot detract therefrom even if the guarantor company itself is in bad straits. Examples: the Brooklyn Union Elevated Railroad Fives were guaranteed by the Brooklyn Heights Railroad Company, which went into receivership in 1919. But the bond came through the reorganization unscathed because of its own preferred position in the Brooklyn Rapid Transit System. Similarly, U.S. Industrial Alcohol Company preferred dividends were guaranteed by Distilling Company of America. The latter enterprise became bankrupt, but the alcohol company was easily able to continue the dividend out of its own earnings and later to retire the preferred issue at $1.25. A common or preferred stock fully guaranteed by another company has the status of a bond issue as far as the guarantor is concerned. If the guarantee proves worthless, it would naturally return to the position of a stock, usually a weak issue, but possibly a strong one, as in the case of U.S. Industrial Alcohol Company Preferred just mentioned. A similar situation obtains with respect to income bonds of one company guaranteed by another. For example, Chicago, Terre Haute, and Southeastern Railway Company Income Fives guaranteed by the Chicago, Milwaukee, St. Paul, and Pacific Railroad Company. The value of a guarantee is sometimes very evident when part of an issue is guaranteed and part is not. Exact terms of guarantee are important. The exact terms of a guarantee have obviously a vital influence upon its value. A guarantee of interest only is likely to be much less significant than a guarantee of principal as well. Examples: Philippine Railway Company First Fours, due 1937, were guaranteed as to interest only by the Philippine government. The earnings of the road itself were poor. Interest was paid promptly up to maturity, but principal was defaulted. The price of the bond reflected this situation, having sold no higher than 39 since 1929. Minneapolis, St. Paul, and Sault Ste. Marie Railroad First Consolidated Fours and Fives, due 1938. All the 4% bonds and about half the 5% bonds were guaranteed as to interest only by Canadian Pacific Railway. Principal was defaulted on maturity, and the Canadian Pacific ceased to pay interest. the price of the bonds declining to 6. On the other hand, this company's first and refunding 5.5s, Series B due 1978, a junior lien, are also guaranteed as to interest by Canadian Pacific, and in accordance with the guarantee continued to receive interest after the senior lien was in default. These bonds sold at 64 in 1939, whereas the senior issues sold at 6. Note that in 1931 they sold as low as 35, whereas the first consolidated guaranteed 5s due 1938 sold at 45, and the Canadian Pacific unsecured debenture stock sold at 56 7/8. It is clear that the value of the long-term Canadian Pacific guarantee was not fully appreciated in 1931. A similar disadvantage attaches to a guarantee of dividends running for a limited period. Examples. The actual working out of such a situation was shown in the case of American Telegraph and Cable Company common stock, which was guaranteed as to 5% dividends only for 50 years from 1882 by the Western Union Telegraph Company under a lease terminating in 1932. Because of the long record of dividend payments, investors came finally to consider the dividend as a fixture, and as late as 1922 the stock sold at 70. But in the meantime, the strategic or trade value of the leased cable properties was rapidly diminishing, so that the value of the stock at the expiration of the lease was likely to be very small. A settlement was made in 1930 with Western Union, under which the American Telegraph and Cable stockholders received the equivalent of about $20 for the principal of their stock. A rather unusual example of the importance of the exact terms of a guarantee was supplied by Pratt & Whitney Preferred, retired in 1928. According to the security manuals, the dividend on this issue was guaranteed by its parent company, Niles Bement Pond. But in fact, the Niles Company agreed to make up unpaid dividends on Pratt & Whitney Preferred only to the extent that Niles had earnings available therefore after payment of its own preferred dividends. Hence, no dividends were received by Pratt & Whitney Preferred stockholders from November 1924 to June 1926 without any claim being enforceable against Niles Bement Pond. In view of the possibility of such special provisions, particular care must be exercised to obtain complete information regarding the terms of a guarantee before purchasing any security on the strength thereof. Joint and several guarantees. Such guarantees are given by more than one company to cover the same issue, and each company accepts responsibility not only for its pro rata share, but also for the share of any other guarantor who may default. In other words, each guarantor concerned is potentially liable for the entire amount of the issue. Since two or more sponsors are better than one, bonds bearing a joint and several guarantee are likely to have special advantages. Example. The most familiar class of issues backed by such a guarantee are the bonds of Union Railroad stations. An outstanding example is supplied by Kansas City Terminal Railway Company First Fours due 1960, which are guaranteed jointly and severally by no less than 12 railroads, all of which use the company's facilities. The 12 guarantors are as follows: Atchison, Alton, Burlington, St. Paul, Great Western, Rock Island, Kansas City Southern, MKT, Missouri Pacific, Frisco, Union Pacific, and Wabash. The value of each of these individual guarantees has varied greatly from road to road and from time to time, but at least three of the companies have consistently maintained sufficient financial strength to assure a terminal bondholder that his obligation would be met without difficulty. Investors have not fully appreciated the superior protection accorded by the combined responsibility of the 12 carriers as compared with the liability of any one of them singly. The price record shows that the Kansas City Terminal Railway Company fours frequently sold at no higher prices than representative issues of individual guarantor companies, which later turned out to be of questionable soundness, whereas at no time was the safety of the terminal bond ever a matter of doubt. It would seem good policy for investors, therefore, to favor bonds of this type, which carry the guarantee of a number of substantial enterprises in preference to the obligations of a single company. Federal Land Bank bonds. A somewhat different aspect of the joint and several guarantee appears in the important case of the Federal Land Bank bonds, which are secured by deposit of farm mortgages. The obligations of each of the 12 separate banks are guaranteed by the 11 others, so that each Federal Land Bank bond is in reality a liability of the entire system. When these banks were organized, there was created concurrently a group of joint stock land banks which also issued bonds, but the obligations of one joint stock bank were not guaranteed by the others. Both sets of land banks were under United States government supervision, and the bonds of both were made exempt from federal taxation. Practically all of the stock of the federal land banks was subscribed for originally by the United States government, which, however, did not assume liability for their bonds. The joint stock land bank shares were privately owned. At the inception of this dual system, investors were disposed to consider the federal supervision and tax exemption as a virtual guarantee of the safety of the joint stock land bank bonds, and they were therefore willing to buy them at a yield only 0.5% higher than that returned by the federal land bank bonds. In comparing the non-guaranteed joint stock bonds with the mutually guaranteed federal bonds, the following observations might well have been made. 1. Assuming the complete success of the farm loan system, the guarantee would be superfluous since each bond issue separately would have enjoyed ample protection. 2. Assuming complete failure of the system, the guarantee would prove worthless since all the banks would be equally insolvent. 3. For any intermediate stage between these two extremes, the joint and several guarantee might prove extremely valuable. This would be particularly true as to bonds of a farm loan district subjected to extremely adverse conditions of a local character. In view of the fact that the farm loan system was a new and untried undertaking, investors therein should have assured themselves of the largest possible measure of protection. Those who, in their eagerness for the extra 0.5% of income return dispensed with the joint guarantee, committed a patent mistake of judgment. Chapter 17. Guaranteed Securities, continued. Guaranteed real estate mortgages and mortgage bonds. The practice of guaranteeing securities reached its widest development in the field of real estate mortgages. These guarantees are of two different types, the first being given by the corporation engaged in the sale of the mortgages or mortgage participations, or by an affiliate. The second and more recent form being the guarantee given by an independent surety company, which assumes the contingent liability in return for a fee. The idea underlying real estate mortgage guarantees is evidently that of insurance. It is to the mortgage holder's advantage to protect himself at some cost in income return against the possibility of adverse developments affecting his particular property, such as a change in the character of the neighborhood. It is within the province of sound insurance practice to afford this protection in return for an adequate premium, provided, of course, that all phases of the business are prudently handled. Such an arrangement will have the best chance of success if 1. The mortgage loans are conservatively made in the first instance. 2. The guarantee or surety company is large, well managed, independent of the agency selling the mortgages, and has a diversification of business in fields other than real estate. 3. Economic conditions are not undergoing fluctuations of abnormal intensity. The collapse in real estate values after 1929 was so extreme as to contravene the third of these conditions. Accordingly, the behavior of real estate mortgage guarantees during this period may not afford a really fair guide to their future value. Nevertheless, some of the characteristics which they revealed are worthy of comment. This business once conservatively managed. In the first place, a striking contrast may be drawn between the way in which the business of guaranteeing mortgages had been conducted prior to about 1924 and the lax methods which developed thereafter. during the very time that this part of the financial field was attaining its greatest importance. If we consider the policies of the leading New York City institutions which guaranteed real estate mortgages, for example, Bond and Mortgage Guarantee Company, Lawyers Mortgage Company, it is fair to say that for many years the business was conservatively managed. The amount of each mortgage was limited to not more than 60% of the value, carefully determined. Large individual mortgages were avoided, and a fair diversification of risk from the standpoint of location was attained. It is true that the guarantor companies were not independent of the selling companies, nor did they have other types of surety business. It is true also that the general practice of guaranteeing mortgages due only 3 to 5 years after their issuance contained the possibility, later realized, of a flood of maturing obligations at a most inconvenient time. Nevertheless, the prudent conduct of their activities had enabled them successfully to weather severe real estate depressions such as occurred in 1908 and 1921. New and less conservative practices developed. The building boom which developed during the new era was marked by an enormous growth of the real estate mortgage business and of the practice of guaranteeing obligations of this kind. New people, new capital, and new methods entered the field. Several small local concerns which had been in the field for a long period were transformed into highly aggressive organizations doing a gigantic and nationwide business. Great emphasis was laid upon the long record of success in the past, and the public was duly impressed, not realizing that the size, the methods, and the personnel were so changed that they were in fact dealing with a different institution. In a previous chapter, we pointed out how recklessly unsound were the methods of financing real estate ventures during this period. The weakness of the mortgages themselves applied equally to the guarantees which were frequently attached thereto for an extra consideration. The guarantor companies were mere subsidiaries of the sellers of the bonds. Hence, when the crash came, the value of the properties, the real estate bond company, and the affiliated guarantor company all collapsed together. Evil effects of competition and contagion. The rise of the newer and more aggressive real estate bond organizations had a most unfortunate effect upon the policies of the older concerns. By force of competition, they were led to relax their standards of making loans. New mortgages were granted on an increasingly liberal basis, and when the old mortgages matured, they were frequently renewed in a larger sum. Furthermore, the face amount of the mortgages guaranteed rose to so high a multiple of the capital of the guarantor companies that it should have been obvious that the guarantee would afford only the flimsiest of protection in the event of a general decline in values. When the real estate market broke in 1931, the first consequence was the utter collapse of virtually every one of the newer real estate bond companies and their subsidiary guarantor concerns. As the Depression continued, the older institutions gave way also. The holders of guaranteed mortgages or participations therein, aggregating about $3 billion guaranteed by New York title and mortgage companies alone, found that the guarantee was a mere name and that they were entirely dependent upon the value of the underlying properties. In most cases, these had been mortgaged far more heavily than reasonable prudence would have permitted. Apparently, only a very small fraction of the mortgages outstanding in 1932 were created under the conservative conditions and principles that had ruled up to, say, 8 years previously. Guarantees by independent surety companies. During the 1924 to 1930 period, several of the independent surety and fidelity companies extended their operations to include the guaranteeing of real estate mortgages for a fee or premium. Theoretically, this should have represented the soundest method of conducting such operations. In addition to the strength and general experience of the surety company, there was the important fact that such a guarantor, being entirely independent, would presumably be highly critical of the issues submitted for its guarantee. But this theoretical advantage was offset to a great extent by the fact that the surety companies began the practice of guaranteeing real estate mortgage bonds only a short time prior to their debacle, and they were led by the general over-optimism then current to commit serious errors in judgment. In most cases, the resultant losses to the guarantor were greater than it could stand. Several of the companies were forced into receivership, notably National Surety Company, and holders of bonds with such guarantees failed to obtain full protection. Leasehold obligations equivalent to guarantees. The property of one company is often leased to another for a fixed annual rental sufficient to pay interest and dividends on the former's capital issues. Frequently, the lease is accompanied by a specific guarantee of such interest and dividend payments, and in fact, the majority of guaranteed corporate issues originate in this fashion. But even if there is no explicit guarantee, a lease or other contract providing fixed annual payments will supply the equivalent of a guarantee on the securities of the lessee company. Examples. An excellent instance of the value of such an arrangement is afforded by the Westvaco Chlorine Products Corporation 5.5s, issued in 1927 and maturing in 1937. The Westvaco Company agreed to sell part of its output to a subsidiary of Union Carbide and Carbon Corporation, and the latter enterprise guaranteed that monthly payments would be made to the trustee sufficient to take care of the interest and retirement of the 5.5% bonds. In effect, this arrangement was a guarantee of interest and principal of the Westvaco issue by Union Carbide and Carbon, a very strong concern. By reason of this protection, and the continuous purchases for redemption made thereunder, the price of the issue was maintained at 99 or higher throughout 1932 to 1933. This contrasts with a decline in the price of Westvaco common stock from 116.5 in 1929 to 3 in 1932. The entire bond issue was called at 100.5 in September 1935. Another interesting example is supplied by the Tobacco Products Corporation of New Jersey 6.5s due 2022. The properties of this company were leased to American Tobacco Company under a 99-year contract expiring also in 2022, providing for annual payments of $2,500,000, with the privilege to the lessee to settle by a lump sum payment equivalent to the then present value of the rental, discounted at 7% per annum. By means of a sinking fund arrangement, these rental payments were calculated to be sufficient to retire the bond issue in full prior to maturity, in addition to taking care of the interest. These Tobacco Products 6.5s were the equivalent of fixed obligations of American Tobacco Company. As such, they ranked ahead of American Tobacco Preferred, dividends on which, of course, are not a fixed charge. When the bonds were created in 1931, the investing public was either skeptical of the validity of the lease or, more probably, was not familiar with this situation, for American Tobacco Preferred sold at a much higher relative price than the Tobacco Products bonds. At the low price of $73 in 1932, the bonds yielded 8.90%, while American Tobacco Preferred was selling at 95 to yield 6.32%. In January 1935, the lease was commuted by a lump sum payment resulting in the redemption of the Tobacco Products 6.5s at par. Specific terms of lease important. Example. As in the case of guaranteed issues, the details of the lease arrangement may have a vital bearing on the status of the issue benefiting therefrom. Some of the elements here involved are illustrated by the following example. Georgia Midland Railway First 3s due 1946. Not guaranteed, but property leased to Southern Railway until 1995 at a rental equal to present bond interest. Price in January 1939, $35. In this case, the lease agreement is fully equivalent to a guarantee of interest up to and far beyond the maturity date. The value of the guarantee itself depends upon the solvency of the Southern Railway. The status of the bond issue at maturity in 1946 will depend, however, on a number of other factors as well. For example, 1. The market value of a long-term rental obligation of Southern Railway. If interest rates are low enough and the credit of Southern Railway high enough, the issue could be refunded at the same 3% interest rate into a longer maturity. This would seem far from probable in 1939. 2. The value of the Georgia Midland mileage. If this mileage actually earns substantially more than the rental paid, then Southern Railway could be expected to make a special effort to pay the bonds at maturity for fear of otherwise losing control of the property. This would involve an agreement to pay such higher rental, that is, interest rate, as may be necessary to permit extension